was only chaos. Then, forged in the white-hot heat of colliding stars, gold. Discovered by humankind in antiquity, the alchemy of dreams. A symbol of our spiritual journey, of our prestige, of our wealth and trade, of our security. It's the best we can achieve. It's how we express love. It can be shaped, sculpted, cast and stretched like no other. It doesn't tarnish or corrode, and electricity flows freely through it. Unique qualities only found together in a single element, the noblest of all metals. That's why it's in our computers and our smartphones, enabling us to connect and share. It's in our electron microscopes and our mountaintop telescopes, helping us to see deeper and gaze further. It's contributing to renewable energy technologies. The tiniest nanoparticles make industrial chemical reactions more efficient, while gold is helping to advance the diagnosis and treatment of disease. After thousands of years at the heart of our customs and traditions, we've only just begun to discover gold's real value, providing security in our ever-changing world and enabling important innovations through its unique nature. Gold, as ancient as the stars, is helping us to explore the universe. It's been at the heart of our past, our present, and now our future, wherever that may take us.
Okay, good morning. First of all, I'd like to thank Carrie again for this wonderful opportunity. It's great to leave gloomy London and arrive in sunny Sydney. Thank you all for your time. That was the dramatic bit, for those of you who saw it, kind of the poetic bit of why gold is so special, why it's such an interesting thing to work with. It's also, I think, worth bearing in mind that after this morning, we may need a few reasons to be cheerful. I think what happy pills Egon said he had in his pocket, well, I think we needed a few happy pills after that, Egon, no offense. But it was certainly a gloomy perspective, and I agree with a lot of it. But I think this presentation, dare I say it, is very much rooted on this planet. It is, if you like, it is focused on what it takes, what it might take, what it means for gold to be a mainstream asset. So, as you heard, I'm John Mulligan from the World Gold Council. In the interest of time, I won't spend too much time introducing who we are. I'm around all day. Please come and grab me if you want to know more. We were formed in 1987, so 32 years ago. We were formed by some of the world's larger gold mining companies who, at the time, and you heard this morning the state of the gold market in the 80s, they were, frankly, vulnerable. They were somewhat nervous about the fate of the product, what gold actually would become in terms of the future. The gold miners, the big gold miners at the time, were relatively distant from the markets, so they were relatively, dare I say, uninformed about the markets, and they wanted a global organization to try and stimulate and sustain demand for gold in all its forms. So that's what we are, that's where we were formed from. The current membership, 26 companies, over 100 productive mines. I think that's about 55% of all corporate gold production, a similar proportion of global market cap for the sector. So a substantial membership, and that is where we derive our mandate. However, a lot of what we do is focused in the markets. We do not necessarily represent gold mining as such. And what we've done, how we've delivered on our mandate over the years has changed very much in line with the evolution of the market, and that's what this presentation is all about, the evolving structure of the gold market. I think I won't read out those bullet points. You're more than capable of reading yourself. But the bullet points that I would highlight are those lower points about increasing investor demand for gold and raising industry standards. enhancing market infrastructure, creating, if you like, an ecosphere, an ecology for gold, where gold can be traded, accessed, and very importantly, trusted across the globe. And that does come to somewhat some of those aspects that Richard touched upon this morning about gold as a tried and trusted product. So how we deliver our mandate has, as I say, changed. We're very much a research-led organization. So we start with data, we start with analysis, we start with our insights. We have offices in the main consumer markets, 2 in China, India, New York, Singapore, etc. That knowledge, that data, that insight allows us then to have credibility in terms of trying to influence policy and influence policy, government policy, central bank policy to some extent, and to, as I say, reshape the infrastructure of gold so that it can be accessible by all, trusted by all. What I'm going to talk about today, and some of this will be familiar to you already, one of the advantages of speaking after a few informed speakers is that they have already introduced a lot of the subject matter I'll be speaking about. But really what I want to look at is gold in the short term, gold now, gold in the long term, what drives gold over a sustained period, and why that long-term structural change, those long-term drivers, why they drive the strategic investment case for gold. Why should investors of scale, investors looking to put large amounts of money into an asset, why should they consider gold? So the short-term drivers, and some of this we've already touched upon. I think Egon mentioned that we shouldn't solely look at the gold price in US dollars. I heartily agree. And undoubtedly, gold in Aussie dollars has performed remarkably well. That's the green line there. That said, I will be focusing on gold in US dollar terms because I'll be looking at the big macro picture. So you've heard a lot about this, the gold and the doldrums for many, many years, then this bull run, and then this period here, the recent past. And the reason why that's important is that actually in the last few months, in the last few quarters at least, the story around gold has been changing, and certainly it's been changing for us and the people we engage with. And looking at that little, looking at those parallel lines here, this sideways trading that you heard about this morning, well, if we look at that in more detail, then you can see, actually, this is where we are now. And for us, this is actually important because you've broken out of this sideways trading, these sideways trading bands. You've broken into a new price environment, and that allows us to have some new, meaningful conversations with not only current investors, but with new investors. So I will very briefly talk about what I think is driving those, this breakout. I think we've already touched upon some of those issues. But this is where we are. This is, if you like, some of the key short-term drivers. We've already heard about the US dollar. It's this decoupling, Fed strategy, trade tensions, etc. So the US central bank and government policy and the tensions between the two. Central bank buying, and I'll come to that later. I have a slightly different perspective on central banks than Egon. I do think in some ways that central bank buying and central bank perceptions are key. I don't necessarily know whether it's, as Egon suggested, whether it's, don't do as I do as I do as I say. But nonetheless, I think it's a very strong story. Really importantly is that last point. That currently, this gold market, that breakout has been driven by investor demand, both speculative, that's very short term or relatively short term at least, and investment demand in the longer sense, institutional investors of scale. And I think That's important because you need to know where we are now compared to where we might be and certainly where we came from. That last point is also key. We'll be publishing the Q3 demand figures for gold next week, and I'm not breaking any embargoes to tell you that physical demand, key physical demand in the consumer markets of Southeast Asia, in fact, key physical demand in all of the markets, apart from some institutional investor markets, it's been relatively weak for the second half of this year and will remain so. That said, as I said, you still have that strong price environment. So why is that? Well, this is one issue. You know, long term, anybody who knows gold will know about the inverse correlation with the dollar. The dollar, actually, the dollar line there it's a dollar index, and it's inverted, and it's inverted just to show you the scale of this decoupling. Basically, as you can see, you have a general tendency for the pattern to be similar. It's a correlated, it's invertly correlated, but the pattern is strong. For the last 6 months or so, certainly last few months, that has broken. So what it means is you can have relative dollar strength and gold can still perform well. And that's a signal of several things, I think, but it's certainly a signal of a shift compared to the last few years, and the last few years in terms of institutional perceptions for gold. That said, and I think I agree with Egon here about the prospects for the dollar. This is the long-term chart looking at, well, relatively long-term chart, looking at periods of dollar strength, and you will see that we're far more likely to have reached the top here, and we're far more likely to be moving down towards a period of weakness. And so even if the dollar was a headwind for gold, which it currently isn't, but even if it was, that would be a diminishing factor. It's currently all about interest rates. And you heard from both Egon and Richard about the bizarre situation in terms of negative interest rates, that 15 trillion or so of negative yield-bearing assets. Very strange to get your head around the fact that huge institutional investors are holding assets that are costing them money. But as you can see, it's a fairly strong trend. And this again, sorry, the interest rate, again inverted, just to show you the strength of the trend. So as interest rates have dropped, gold has been supported. Now, I could have shown you other charts in terms of short-term drivers. We could have looked at COMEX. We could have looked at the long net positions and futures positioning for the money markets, and you'll see a strong support there for the current price movements. But I don't want to dwell upon the short term. This is where we are, the new normal. A lot of those issues that you've heard about this morning, low real interest rates, negative interest rates, a low yield environment, low productivity in the developed economy. So all of those are problems, vulnerabilities with the global economy. It just so happens that over the last 4 or 5 years, certainly post-Trump election, there's been a focus by institutional investors on equity markets, and specifically the US equity markets, and that has led to gold largely being neglected by institutional investors, certainly institutional investors in the West. During that time, the physical markets have been relatively stable, relatively robust, but that isn't reflected in supporting a rising price. Key to the longer term is the relationship between these two bullet points. When global growth is okay, and by that I mean okay, I mean that the economy is ticking along, consumers are relatively confident about their discretionary spending power, their income levels, they're not particularly worried. And when you're in that environment globally, that's actually fairly strong for physical demand for gold. It doesn't necessarily mean it's strong for an immediate rising price. Where we are now is here. Global growth slowing, many vulnerabilities along the horizon, and that focus on US equities starting to, I think, flag in terms of people questioning where the valuation, where the future value is, and whether those valuations are sustainable. And I agree, again, with Egon, if you look at the Schiller CAPE index, basically an index of price-earnings ratios over the long term, basically you start to see that the equity markets look like they may well be in bubble territory. So I agree, and that's what we're seeing now. So that's the kind of short-term picture. But that isn't the only picture for gold, and that is the picture that you will hear if you tap into the analyst sheets from the bullion banks and most metals commentators. They will be talking about those things. But that doesn't tell you why you can have confidence, why you can have reasons to be cheerful, dare I say it, in gold over the long run. So the long-term drivers for gold. You will hear many, many times, particularly in a mining environment, that this is a cyclical market. I would challenge that somewhat. I agree the equity markets are frequently cyclical, but the gold market overall is a growth market. This is the volume of demand globally since the gold price was freed. Excuse me. So as you can see, a fairly strong growth trend. Very importantly, however, look at this period here. And this is just a 30-year period, the dark bars, 30 years. You will see growth in demand. In fact, the World Gold Council was formed just here, and our mission statement was to grow demand. And we thought we did, but the price actually fell. This is not commodities 101. This is not supply and demand. Gold is a commodity, but gold is, as we've heard this morning, also money. And the investment component in that demand is key, and I'll come to that again. But just remember that. But as you can see, overall a growth market, and this is the value of that demand. So very substantial, and there are reasons for optimism in terms of the long-term growth trend. What have been the triggers of that growth? What have been these structural drivers I talked about? And you've heard some of them mentioned this morning. Well, central banks. So whether you see them as your friend or your enemy, central banks have been key in terms of the trigger that their change in position on gold, from gold sellers to gold buyers, that's been key in terms of shaping how the world looks at gold. Investment demand, I mentioned the importance of investment demand in creating value, not just volume, but value. And then that west to east. You can't go to any gold presentation without talking about west to east. But I think it's always worth bearing in mind actually what that means in terms of the drivers, how that feeds into the drivers of an asset. So just to look at the scale of that change, central banks, this is the PBOC, the People's Bank of China. In 1989, 30 years ago, they sold 432 tons of gold. They were sellers for many, many years. In 2018, they bought 657 tons, which is a huge amount when you consider the scale of the total market, around about 4,200 tons or so of demand. That's from one source, from a source that used to be a seller. That is very significant. That continues to this year. I've seen the data. The stats for this year will continue to be strong. Central bank, the emerging nation central banks have been key. The Europeans, you heard about the gold standard this morning from Richard. The Europeans still own a lot of gold, central banks, because of the legacy gold standard. They were sellers. They were, for generations, certainly for decades, they would sometimes sell fairly substantial amounts until 1999. And then they started to moderate. Then the financial crisis came along, and they reassessed those gold holdings. Now the developed central banks don't sell, and the emerging market central banks buy for many reasons. Probably too many to go into here, but happy to talk about it later. And that's quite important because, again, Egon said central bankers don't understand gold. Well, they increasingly do, actually. We We have a training program for central bankers that's been running for 5 or 6 years now at Cambridge, at Berkeley, in China, in Singapore. I think we've had 60 different central banks, maybe more, come to that training course to learn about gold as a reserve asset. So I think there has been a change in terms of central bank perceptions, certainly positions, and I think increasingly central bankers do know something about gold. Just to mention the clip that Egon showed this morning of Greenspan speaking, that was Greenspan speaking at a World Gold Council event where we invited him to speak about gold and the global financial system. So again, I think it's worth bearing in mind the significance of that shift. I mentioned investment demand, that basically it's, yes, 50%, 52%, something like that, of all gold goes into jewelry. And that is important for many reasons. It's important because that is a completely different motivation, a different driver of gold than investment demand. But investment demand has been key, as I say, and if you noticed that all of the price charts that we've shown, all of them show the price starting to rise around about this point. This is the ETF holdings. Currently, I think, around 2,800 tons of gold currently taken off the market by the gold ETFs. European private investors. Now, European private investors is something that we don't hear about often. European private investors means individuals, many of them probably Egon's clients, individuals, private wealth that buys bars and coins in Europe. That was a dead market. Well, it was certainly a neutral market for many years. It was, when I started the World Gold Council, my colleagues in the States would say, why do you bother with European investment programs? Nobody buys gold in scale in Europe. Well, guess what? The global financial crisis came along, and suddenly they did, to the scale of 2,630 tons in the last decade. Again, a very substantial amount of gold bought by private individuals or private wealth. And the reason that that's significant, not only in terms of scale, but is because they could, that turned pretty much overnight from being a quiet or like a market that was net neutral, shall we say, as many sellers and buyers, to being a very substantial market. And the reason why that's important is because of access. Because Germans, Swiss, Austrians to some extent, they actually could access gold. So when the need came, they were aware of gold as an asset, they were aware of gold as a store of value, aware of gold as an asset of last resort, and they could go to their banks and buy it. That is a huge opportunity for gold looking forward, because guess what? If I go to a bank in the UK and ask them to buy gold, they will probably laugh at me. They will certainly not know what I'm talking about. So there's a huge amount of potential market development that can be done in terms of creating access to gold. I said no presentation is complete without a discussion on west to east. It's worth just noting the scale of this change. In 1989, only 30 years ago, China and India combined, the world's two largest physical markets for gold, they only accounted for 10% of demand. Demand was actually, gold was a developed market. Gold was driven by consumers in developed markets. That has radically changed. Very, very importantly, is this figure. Private investment in gold in China was illegal until 2004. You couldn't own bars and coins in China. Soon as that inhibition was removed, basically demand has flourished. Again, demand and access being key. So from west to east, well, we hear an awful lot about the global market downturn, the problems with the Indian economy and the Chinese economy. However, this is the FT in March of this year. The Asian century is about to begin. Not it's all happened, it's about to begin. This is a GDP on a purchasing parity basis. Basically, combined, the economies of Asia will overtake the developed world quite soon. In fact, they already have in terms of purchasing power. So this is a very substantial change. And just to quote the FT, Asia is due to return to the center of global economic development. And I think that is one of the reasons why that looking at the long term, looking at the structural changes of gold, looking for gold, what gold performs, how gold performs as an asset is key, because what people often don't talk about is gold as a proxy for that socioeconomic development. If you look at how gold has developed in the Indian markets and the Chinese markets, it's remarkably closely correlated to how income has grown in those countries. Diversity of demand. Two big things I'd like people to take away from my presentation is this idea that basically the market is a growth market and it's a diverse market. And that diversity is absolutely key. For me, gold isn't purely money, it is many, many things. In fact, it's probably all of the things that people will talk about at various gold conferences. And that makes it a uniquely stable asset because so many drivers are actually informing the price. And supply is increasingly diverse. So if you look to 30 years ago, 52% of the world's newly mined gold came from 3 countries, with South Africa dominating. Well, then it was 30%. Rewind that 20 years ago, and that would be near that 30% would be nearer 70%. So very much a concentrated market geographically, a market prone to supply shocks, therefore a market far more volatile, far more risky than the current market that we see today. Now, China may be the largest producer, but not by very much. No one country dominates. Obviously, Australia is a major producer. So it's a global production base, and that is key in terms of this being a stable asset. And again, of course, given the gold mining presentations to come, the value of that gold mine has risen too. So that's why it's important to remember this is a growth market. Recycling. Diversity of supply, not only from mining, but from recycled gold. Recycled gold has grown to represent 25 to 30% of supply. Again, that means you have a stabilizing factor in the gold market. Unlike platinum, unlike oil, unlike silver, you have this pool of gold that can quickly come back to the market if there is a sharp movement in the market. If there's a price spike, for instance, gold will then be sold back into the market, reducing the volatility in that market. So it makes it a very strong, compelling driver of a relatively low volatility asset, which is key when you consider gold as what I call a foundation asset. So all of that informs the investment case for gold. I'll give my voice a rest. You can hear it's a little croaky.
Gold means many things to many people. But no matter the place or person, there is one thing that transcends all boundaries and borders: security. For parents who look to the future, it is a trusted store of value through the ages. For investors who guard against risk, it is a cornerstone of a diversified portfolio, and it delivers long-term returns. For nations looking to preserve their capital, their central banks have been increasing their gold reserves. Why? Because in a world of uncertainty, gold stands proud as a reliable asset, which does not carry credit risk. So one need not worry about repayments to be made or a company's performance. Its value cannot be debased by regional conflict, political upheaval, nor loose monetary policy, and it protects against inflation and currency fluctuation. Gold has always been a trusted store of value for humans, a unique and dependable investment choice. That's why, in uncertain times, the certainty of gold shines ever more brightly.
or simply put, gold has many drivers. There are many pillars to why gold is what I've described as a foundation asset. Key to me are the fact that, yes, it's a source of long-term returns. You saw Egon's charts about that earlier. It's very important that it can balance market stress, and that allows it to function as a diversifier, and that in turn basically means it can enhance portfolio performance. So taking all of those things together, that idea of the structural evolution of the market actually drives this as a foundation asset, an asset that should be at the basis of institutional investment portfolios, and in fact, as you heard, probably all portfolios. So I'm running out of time. Just on my last slide, very fortunately, in conclusion, I won't read all of this. I probably already said it. Very, very importantly, increased diversity, a growth market driven by the structural evolution in terms of both supply and demand. And if you take all those things together, basically, that is why I believe you can have confidence, and there are reasons to be cheerful, not just a parade of fear in terms of driving you to gold, but reasons to be confident that gold becomes an enduring store of value and a foundation asset for the future. Thank you.